Hi guys, we're the investors from CollegeInvestr.com, and we're here to talk to you today about our 5th video in our financial success series.
Today we're going to be talking about a basic guide to the stock market, as well as an overview of what stocks are and different types of funds and indices.
Thanks for watching.
Enjoy. Alright, so today we're talking about stocks and the stock market. David, why don't we start by explaining the basics?
Okay, so stocks are essentially parts of a company. They are parts of a company. We use the term shares to also describe stocks or pieces of stocks. So you hear the term stockholder and shareholder, they're essentially the same thing. So first we need to differentiate between publicly traded companies and privately held companies.
And the difference is largely based on how do they generate funds. Publicly traded companies do so by people buying and selling on the stock market and investing in that way. Privately owned companies are usually they generate their funds internally.
Right.
It's usually a founder, the founder's family.
You know, just investors in the company that
Right.
You have to be
Or people
basically
invited in.
Yeah, you
Yeah,
just get to
stuff
be
like that.
invited. It's not everyone can buy part of the company.
Employees for big companies like that
Right.
can often stock options, stuff like that.
But those publicly traded companies, which we're going to talk about today, anyone can buy that stock. So
Right.
that's the most important part.
So back to shares.
Right. So what an actual share is it's essentially, think about a pie, okay? And we're going to cut this pie up into a whole bunch of different pieces.
Millions of pieces.
Millions of pieces, and this pie is actually representing the company. And these slices of pie, okay, we're going to sell to shareholders, okay?
So you can have bigger or smaller shareholders based on how much they buy.
Based on how much they buy. If you want to buy 100 slices, you can. If you want to buy 100 billion slices, go for it. If there's enough stock out there. So that's
And if
basically
you've got the money.
Exactly. If you've got the money to buy 100 million slices of anything. So basically, that's essentially what a stock or a share is. And the value of a share is determined by the market or the people that are buying it. Okay. So basically, the demand for a stock or the demand for a share determines the price.
So people have a lot of faith in a company. They'll go out, they'll buy some, they'll be willing to put their money into it. Conversely, the same thing can happen when people lose faith in a company. People can start to pull out, start a trend, and start a downward spiral.
Exactly, and the price will go down. So that's essentially how it is. It's all based on speculation and also based on the feel or the kind of the market feel for it.
Right. So say a company announces they're doing really well and they think they're going to do better. The price for that company will prematurely go up because people say, okay, well, they're expected to do better.
Right.
I'm going to buy now while it's cheaper than it would be when they are more successful.
So we're talking about, buy low, sell high. That's essentially the concept we're thinking of here. So that's basically how we get the idea of stocks and the price.
So where are stocks traded?
Yes. So
where does this take place?
Stock exchanges are essentially what we need to talk about next. And the 4 ones that I can think of off the top of my head that I think are the biggest ones that you might know are the New York Stock Exchange, which is the big one. The Chicago, London, and Tokyo also have other ones.
Most major cities have one.
Yeah.
Think about in a movie with people who trade and invest. There's people running around the trading floor yelling, buy, sell, buy, sell. That's taking place at a stock exchange.
Okay, so that's essentially what a stock exchange is, and that's where the buying and selling of stocks, publicly held or publicly traded stocks, occurs.
Right.
So next we need to talk about indexes, or indices, excuse me.
Right. So think about when you're watching the news and you see that little ticker on the bottom of the screen with the NASDAQ, the Dow Jones, the S&P 500. Those are all indices. So an index is a collection of things, and an index of stocks is no different.
Exactly, it's a collection of companies or collection of stocks.
Right, and it could be a collection based on all these stocks are in one sector, and that's the same as industry. Those words are kind of interchangeable. So it could be a collection for whatever reason, the sector.
Like the energy sector, it could be it could be industrial, could be services, any kind of
The S&P 500, for example, is the 500 largest companies traded on the New York Stock Exchange.
Exactly. So there's different ones. There's a whole bunch of different indices, and they all represent different kinds of things. It's a way to track the market, a way to look at the market and say, the energy sector is doing really well because they looked at the the energy index. So that's doing well. The companies inside of it are doing well. Obviously, the index will go up.
Right. And
so
there are a lot of factors that contribute to how people buy and sell in the stock market that also carry over to the economy too. So when you hear people saying, "Oh, well, the market's up, the economy's good," it's for those reasons. People's confidence in their currency, overall money flow in the country.
There's a lot of things, they correlate with each other. So that's kind of what an index is. It just kind of gives you a wider view, gives you a kind of an overview of that kind of whatever it's mapped.
Right.
Yep.
So a lot of information, but next let's talk about funds and different types. We have mutual funds, index funds, and hedge funds. Hedge funds are really
It's a private kind of thing. It's
Right.
a little bit, yeah.
We're not going to talk about those today. It's
Right.
more of an exclusive kind of group kind of thing.
Right.
For more advanced investors. But mutual funds and index funds. Index funds, we just talked about indices, and basically that's all you're doing is betting on one of those indices,
Exactly.
or putting your money behind it, investing in it. So if you think the S&P 500 is going to go up over time, then you could invest in that indice.
Exactly. So what we've seen is the market
And that's all
normally
an
does.
index
Yeah,
fund is.
the market normally does pretty well. We've seen an average of
Historically, we've seen that the market as a whole tends to grow.
Exactly. So if you want to make it extremely simple, the index funds, they just invest in the 500 companies of, the S&P 500, or the Dow Jones has quite a few more than that. But I mean, essentially what it's doing is just taking all of the companies that are in an indice and putting it into a fund. It's extremely simple. The fees are pretty low. It's very simple to track.
Well, and it's proven to work.
Exactly. It's proven to work.
So mutual funds are a little bit different. They are managed by somebody or a group, usually professional, somebody who does know a lot about investing and economics, that kind of thing. The trade-off is they're usually a little bit more expensive with the fees, and sometimes you have to pay a commission on whatever your money makes while they're investing it.
Exactly.
But the difference is you're getting a hand-picked, diversified investment portfolio by an expert.
Exactly. So they're actually going to go out there and they're going to go do some research. They're going to do some analytics, and they're going to find those companies that they believe are the winners.
Right.
The ones
so
that they really like.
they're trying as hard as they can to beat the market, and it's interesting because that sounds like a great
Fantastic. It sounds like you're getting a hand-picked,
Yeah.
Exactly.
But what's been shown really,
in the data recently, yeah.
the data is that index funds
Beat out
mutual funds.
They're saying
Which is
now
kind of
that,
surprising, but that just demonstrates that
Exactly.
the stock market as a whole is going to keep growing.
Exactly. So basically, the mutual funds, 80 to 90% of the time, don't beat the market. So I think that's important to
Just because the
illustrate.
stock market is such an unpredictable thing.
Exactly. Yeah.
The recession from a couple of years ago,
2008. Yeah.
the Great Depression, these things happened, and people who were hedging their bets a lot of them really got screwed over. But those were just lulls where the market did eventually bounce back and continue to keep growing.
Right. So these mutual funds, essentially, like we were talking about, they're hand-picked portfolios. Trying to compare the index funds and the mutual funds. Basically, what we're looking at is index funds are extremely simple. They're easy to track. They're proven. They have low fees. Mutual funds, you're getting that kind of that hand-picked experience. You're getting a fund manager that you could talk to. Sometimes, depends on where you're going. But that fund manager is going to be picking the best stocks that he or she thinks is best for the mutual fund.
Yeah.
The fees for mutual funds are higher. That's across the board, just because they have to pay the people that are actually doing the research and also that are actually managing the fund. So mutual funds, higher fees, and not necessarily beating the market. Index funds, lower fees, and track the actual market itself. So that's basically the two funds that we're going to talk about.
Yeah, and that's most of what we have for you today.
Right.
If you do want to get into investing, it's really not difficult. We've talked about it before. Download an app like Acorns on your phone. Try that out. Link your bank account to it. Put a couple bucks in here and there, and just it's neat to see how your money starts to kind of fluctuate with the stock market, and it's a good way to get started.
If you want to get started with Acorns, we'll have a link below. It explains it to you in simple English. You'll be able to easily understand what it's going to do and what you want.
Right, and moving on from there, should you decide, okay, I've got a favorite company, I really believe in them, or maybe you have some other reason why you want to start investing, just look up an online brokerage account and keep an eye out for something with pretty low commissions and
low fees.
Right, try that out.
So popular ones are Vanguard, Charles Schwab, stuff like that. But yeah, definitely that's how we want you guys to look at stocks, and that's basically how to get involved. Thanks for watching. We want to remind you that we have another video coming up, and it's
wealth goals and spending habits as you get older.
That'll be coming up soon. Should be coming out tomorrow. And so yeah, we appreciate you guys for watching.
Thank you.
Hey guys, thanks for watching the video. Don't forget to like, comment, and subscribe below.
And be sure to check us out on social media. We're CollegeInvestr on Instagram, Facebook, Pinterest, and Twitter.
Also, check out our website, CollegeInvestr.com. CollegeInvestr.com. There's no O in investor.
People working.
We appreciate you, and links will be below. Thanks.
Thanks.